In order to fully understand corporate finance, we need to have a broad view of all the stakeholders involved and the context they are situated in. In the broadest context, there is the market, which is a variety of systems and institutions that engage in the exchange of goods and services, and the government, which interacts with the market but does not operate by the same rules. Within the market, there are two main concepts. On the one hand, there are different industries that shape the companies within them, and on the other hand, each company has existing shareholders and potential investors, such as individuals, other companies, and institutional investors that could be within the same industry or not. Companies have three main financial statements, namely the balance sheet, income statement, and cash flow statement. By using these tools, companies can make both long-term and short-term financial decisions. From the short-term perspective, the company is concerned with being able to meet its financial obligations and analyzing its financial needs, as we have seen in the Cartwright and Quesos de Menorca cases. To analyze the financial and economic situation of a company, different ratios are used, such as ROA, ROE, ROCE, etc. After analyzing its situation, the company must make decisions regarding its short-term financial policies. It can either finance its operational activities through its suppliers, which is a rare situation of negative working capital in companies like Apple, or by borrowing debt from financial institutions. Given the low interest rate environment and the difference between the bargaining power of suppliers, most companies decide to be financed with debt. From the long-term perspective, there are two main concerns a company must deal with: capital structure and dividend policies. Dividend policies refer to the decisions taken regarding the dividends paid to investors as a reward for the risk they take when investing in the company. There are four main types of dividends: ordinary, extraordinary, preferred, and scrip dividends. Ordinary dividends are a share of the company's profits passed to the shareholders on a periodic basis, which implies that they have an implicit commitment. It is important to say that this type of dividends offers some flexibility to the company because they can be reduced yearly, but the company has to take into account that a reduction in dividends can send a bad signal to the market. Extraordinary dividends are paid only once as a form of compensation for shareholders, and they do not imply regular payments, giving the company more flexibility in their policies. Preferred dividends are similar to ordinary dividends, with the exception that they have more seniority when a company distributes shares and in case of bankruptcy. They also have higher dividend rates and are guaranteed. Lastly, scrip dividends are an alternative way of compensating shareholders by offering them the option to receive either cash or free stocks. This way, the company can reinvest the cash while still rewarding shareholders. However, the value and power per share decreases. Capital structure has to do with the extent to which companies want to leverage their company, that is, the proportion of debt and equity in the balance sheet. Both bear a cost. The cost of equity is determined by the return demanded by investors, shareholders, and potential investors, while the cost of debt is determined by interest rate demanded by the financial institutions and is tax deductible, thus making it more attractive to firms. From the equity side, we can increase the level of equity by issuing new shares or decrease it through a buyback. An issue of new equity allows the company to change its capital structure, but usually the main objective is to obtain cash for financing new investments, for example. The main drawbacks are that earnings per share, price, and the power per share may decrease. Companies tend to issue new equity when they believe the firm is positively viewed by the market, overvalued, and there is enough demand for allocating new shares. On the other hand, when a company does a buyback, it uses cash to purchase existing shares from shareholders and thus reduces both cash and equity in the balance sheet. The main advantages of this strategy are the increase in share price and earnings per share, which is a main bonus metric for managers. This is an example of an agency problem, which is a conflict of interest that may arise between the managers of the companies and the shareholders when the company believes that it is undervalued by the market due to asymmetry of information. They may repurchase shares to signal this to the market. From the debt side, cost of debt is determined by financial institutions. Due to the recovering economic situation, the Fed and the ECB have decided to engage in expansionary monetary policies and have set really low interest rates, between 0 and 1%. This implies cost of debt usually lower than cost of equity, which incentivizes companies to obtain greater financial leverage in order to finance their activities. Furthermore, interest paid on debts are tax deductible, which is another big incentive for companies to borrow debt and has sometimes led the companies to become over-indebted. Following this train of thought, some companies try to avoid paying taxes, which is legal, or evade them altogether, which is illegal. Common tactics for tax avoidance include double taxation, which refers to the exploitation of international double taxation treaties, transfer mispricing, which is when the companies in the same group trade with each other in order to distort prices, and the creation of an offshore jurisdiction, meaning the establishment of headquarters and subsidiaries abroad. Companies that have a large amount of cash in the balance sheet, a practice often referred to as cash hoarding, often use this offshore jurisdiction method in order to pay little or no tax on this cash. Cash hoarding is typical in high-tech and high R&D companies, or companies in industry with idiosyncratic market volatility. Its main advantages are increase in probability of surviving economic downturn, reduced dependency on external financing, liquidity for financing M&As, investing in R&D, and tax efficiency, while the main disadvantages are pressure from politicians and investors. Going back to the relation between the company and the investors, the main tool for determining the company's worth is valuation. The two main valuation methods are discounted cash flows and the market multiples. The idea of the DCF method is to calculate the present value of the company by discounting all the future cash flows, usually 5 years in the future, using the weighted average cost of capital as the main discounting rate. The WACC is composed by a proportion of equity and debt, and the higher it is, the lower the valuation of the company is. This present value of the company is a comparable measure to the enterprise value of the company, which is basically the market capitalization of the company, which is number of shares times the share price, plus the market value of debt minus cash and cash equivalents. The difference between the value obtained with DCF method and the enterprise value is that the former is obtained usually using internal figures and the latter is obtained using market values. Equity value is calculated as the enterprise value plus cash and minus debt, and it represents the market value of equity owned by shareholders. Market multiples are another way of evaluating companies and allow potential investors to compare similar companies using market values, the most common of which are enterprise value over EBITDA, enterprise value over sales, price-earnings ratio, and price-to-book value. The underlying assumption being that the value of an asset is whatever the market is willing to pay for it. Valuation can be a powerful tool for companies when they are trying to acquire other companies in the market, as they can find which companies are undervalued and buy them for a cheap price. The main reason for companies to engage in mergers and acquisitions is a search for synergies, which could be either operational, like the increase in income by expanding the business or reducing costs, or financial, like optimizing the capital structure of the acquired companies, like we saw in the Heinz case. The main difference between mergers and acquisitions is that the former happens when both companies get similar control of the company, while in the latter, the acquirer gets a majority stake in the acquired companies. The mergers can be paid in stock, usually offering a higher price because the risk is higher, or in cash, usually offering a lower price because there is no risk. When M&As are done in a very large scale, they are called mega mergers, as both the acquirer and the acquiree are very important players in the industry. Mega mergers are usually done through LBOs, leveraged buyouts, which are acquisitions of companies using significant amount of borrowed money. Valuation methods are also vital for assessing IPO opportunities. Some of the main reasons why a company would decide to proceed in an IPO are the increase of liquidity, like in the product case, or to meet legal requirements, like the 500 shareholder threshold rule the SEC has put, like we saw in the Facebook case. One of the positive consequences of going public is that the company keeps the ability to maintain control of the management of the company. On the other hand, the main drawback is the fact that the company has to commit to its investors in terms of disclosure of information. When doing an IPO, the company must be able to sell themselves and convince investors of positive growth prospects. Initial public offering can offer investors both new shares in a primary offer or shares from existing shareholders in secondary offers. In order for an IPO to be successful, an oversubscription is a good signal, as demand for shares is greater than the supply of shares, which can make the price go up. Nevertheless, it also implies that a greater price could have been charged initially and the issuer could have raised more capital. Another investment option is alternative investments, which can offer greater portfolio diversification and better risk management, as they are uncorrelated with the market. Nevertheless, investors need to be careful as they tend to be illiquid and volatile, as they have their own risks associated with their nature. There are 5 main types of alternative investments: hedge funds, private equity, real estate, commodities, and collectibles.